How big of a bind is the Fed in right now?
This is, we're in extraordinary times. If you look back at early 2008 and 2009, there were 3 other instances in the aftermath of the financial crisis that we had 6 consecutive months of falling car sales. There's clear, so we've never seen this outside of a large recession. This is clearly more than a semiconductor story here. We have housing that is beginning to roll over as well. And many other signs are proliferating worldwide that global growth is slowing. There's a bottleneck recession that's very obvious. It looks like we might be headed into an industrial recession as well. I'm going to be paying close attention to Germany's business confidence data that come out later today. And on top of that, it looks like we're also going into an earnings recession. So there are a lot of slowdown indicators, and yet we have runaway inflation. We have every sign that this bottleneck recession is global in nature. And what a lot of people are not talking about is that in exchange for working 24/7 at the biggest ports on the West Coast, that there might be a lot of payback coming into July the 1st of 2022. We could be talking about a big strike among the longshore workers, among port workers. And really, that's on nobody's radar screen. If we start to hear rumblings about that, you will really see inflation be persistently higher, and it's beyond the middle of 2022 we're talking about here.
But you constantly, you hear a lot of guests on the show say this is a supply side issue, and the Fed shouldn't really be reacting to it. And yet you see markets are pricing in several hikes by the end of next year. Do you think that the market is right on that call, that they're going to have to hike a little bit more faster to deal with these inflationary pressures?
Well, there is always going to be payback in some form for the Fed getting so far behind the curve, for the Fed refusing to start tapering, especially its mortgage-backed securities purchases, even as home prices ran amok. So I don't think that the markets are necessarily incorrect in what they're pricing in. That said, I could still see, I'm going to speak out of the other side of my mouth, I could still see the Fed prematurely pulling the plug on tapering if it slows the markets enough. That's why I say it's going to be a policy error or a policy error. It's very difficult to tighten into a slowing economy, and yet it looks like they're going to be forced to do just that. But fighting stagflation with the current tools in central bankers' toolboxes, it's not an easy thing to do. Stagflation is a different beast.
Danielle, it's fair to assume that the Fed may have to tighten more aggressively than what's been factored in. How do you hedge against that?
It's a very difficult place to be, especially headed into a midterm election year that is promising to be very contemptuous. It's going to cause a lot of headline risk going into 2022. If you look at what happened in 2011, 2012, and 2013, consumer staples, gold, these were long maturity bonds. We're seeing a flattening of the yield curve, but that's because we're seeing shorter maturity rates come up, even though longer maturity rates seem to have found something of a ceiling. Again, these are signposts of stagflation, but your longer maturity bonds did outperform in such an environment. If we look back to the last time there was this much political rancor at the same time of economic upset in the U.S. economy.
Is it inevitable that higher yields will lead to lower stock prices? That's not reflected in the equity markets right now.
There's not much reflected in the equity markets right now. I think what we're seeing is the power of passive investing, which is enormous because of the way by which many American workers' 401ks feed into the stock market. Every single time they get paid, there's money that's pulled out, and the multiplier effect is estimated to be somewhere around 17 times. Share buybacks are pushing record levels, and you've still got the Fed pumping $120 billion worth of liquidity into the stock market. So there's a massive offsetting force that helps explain why stocks seem to have a floor underneath them. But again, all of these things can change if the perception even begins to emerge that especially junk bond issuers, are going to have a harder time accessing capital markets at a time when U.S. corporate debt has exploded from $10 trillion prior to the pandemic to pushing $11.5 trillion. If you add high yield bonds together with leveraged loans, you've already passed a $3 trillion milestone. There's a lot of debt that's still in the system. Credit is still an issue. And I think that that's where you would look for the first crack, because that is what we saw in 2018. We saw a credit market event spill into and bleed into the stock market.
What's also changing is the energy space, this credit crunch, and we're seeing oil, surging ever closer to $90 a barrel. How might this play out? Who might get hit? Which asset classes are you looking at?
Well, I think it's fairly obvious that consumer discretionary, and again, consumer discretionary deeply underperformed. Small cap stocks underperformed with similar backdrops. $90 a barrel is really going to start to cut into U.S. consumers' wallets, their paychecks. Deloitte came out with a survey last week that showed that lower income Americans this holiday season were planning on spending 22% less. We have to recall that food inflation is still very prevalent here in the United States, in addition to what's happening with energy prices. The best hope that we can have right now is Mother Nature. We just have to hope that the La Nina effect doesn't make for a very cold winter, but it's also a global phenomenon that's pushing up energy prices. So we're all going to become meteorologists in the months to come.